Good afternoon. I'm Becky Stevenson, Chief Client Officer and Managing Partner at River Wealth Advisors. Welcome to today's webinar. While we typically focus on the quarter in review and then also looking forward, because of the volatility that we've experienced so far this quarter, we also want to make sure that we're addressing the current state of the economics and markets as they stand today. We also received a number of questions in advance, so we appreciate those clients who sent those questions in advance, and we will try to address those during the webinar. I'd now like to introduce our presenters. Ed O'Gorman, to my left, our Chief Executive Officer, Chief Investment Officer, Wealth Advisor, among his many hats. He will be discussing the markets. Debbie Hippensteel, who has been part of our webinars since the inception. She is our Senior Portfolio Manager. She's out of the Lehigh Valley office, and she also manages that office. And then Bradford Houchins, who made his great debut in the first quarter, is back again this quarter, and he will be wrapping us up at the end with a financial planning topic. So in terms of our agenda for the day, as we always do, Ed will start with Q1 market performance. He also will be addressing current state as well as market expectations. Debbie will discuss economic conditions. And then at the end, Bradford will be discussing how to remain rational in investing in an emotional market, as well as the opportunities that we are able to find in the distressed markets. So that is a positive spin on where we currently find ourselves today. So we have a great webinar ahead of us. And with that, I will turn it over to Ed.
Thanks, Becky. Good afternoon, everyone. I appreciate your taking time out of your day to participate in our webinar. I'm going to walk through sort of our standard update on where things were in the quarter for the first quarter of last year. Also, as Becky mentioned, sort of highlight what's happened since then and where we are today. Looking back at the first quarter, we had a down U.S. market higher internationally, and another one of these few quarters in the past, really 15 to 20 years where we had international markets outperforming the U.S. Bonds relatively stable in the first quarter, but a few things have happened since the end of March. Of course, we all know we've got concerns over tariffs. We've got weaker consumer sentiment, fears of inflation related to tariffs, fears of an economic slowdown related to tariffs, which is something that we'll refer to as stagflation fears. We had the announcement of wide-ranging reciprocal tariffs. We had the concerns more recently of interference with the Fed's independence in Washington, really kind of a breakdown of international trade relations, and a continuation of wars in Ukraine and the Middle East. So there is a lot going on. So to look at the first quarter, is really leaving a lot out of the conversation. So we are going to try to address much of that. I will say, in terms of first quarter returns, we'll touch a little bit more on this as we go along and where we are now. Obviously, a lot of the policy prescriptions have been deferred or walked back. And we had been at one point from the peak down significantly on the U.S. market. At this point, year to date, the U.S. market, using the Russell 3000, which captures large, mid, and small cap stocks, is down about 6.37% year to date. So again, year to date, it had been as low as 11%, significantly more than that from its peak. But that is where we stand at this point, down about 6.37%. International still holding up relatively well, a little bit better than where the quarter ended, up about 7.88% in developed markets. A big piece of that has to do with a weaker dollar. So dollar started to weaken in February, going into March, as concerns about tariffs were starting to surface. The dollar index, which is essentially the dollar, trade weighted dollar relative to a basket of currencies, is down about 10% from its peak earlier this year. So that really kind of gives a bit of a boost to foreign market returns. But that is kind of where we stand so far this year. Looking at long term, and we had a question, as you can see, long term, 1 year, 5 year, 10 year, 15, 20 years, we still see positive returns pretty much across the boards for equities. Over the 5-year time period, we do have a negative return there for US bond markets. That has a lot to do with how low rates were and how much they've kind of come up since then. But we had a question about staying the course, and what does staying the course look like in the long run? Well, this is what the long run looks like, and Bradford's going to spend a bit of time talking about this as well. And I'm going to circle back to talk a little bit about kind of markets and the functioning of markets. But if there's fundamentally, investors are taking risk because they anticipate receiving a return for taking that risk. And that when we're looking at the bottom line on this chart, what you're seeing is essentially, far left column, taking equity risk has, over the long run, returned about a 10% rate of return on an annual basis. Investing in bonds, which are a significantly lower risk asset class, has returned, 3.5% over a long period of time. We are going to have times like these where returns go negative. But over the long run, what you should anticipate is that investors are going to continue to demand a return for putting their money at risk, and that long-term returns have been pretty consistent. If you were to look back at the end of last year, that 10.08% return has changed by about 0.1%. So it was 10.2. So these numbers don't move a whole lot in the long run. So I just want to kind of reinforce that with this chart. Moving over to a little bit of a closer look on fixed income markets. So, again, in the first quarter, returns were low but stable in fixed income markets. Looking at where we are today, returns look very similar to where they were at the end of the first quarter, but there was significant volatility in bond markets around the announcement of tariffs. So yields, and looking at kind of longer term bond yields, rallied or moved significantly lower shortly after the announcement of broad-based tariffs. That was the bond market reacting in sort of the anticipation of much slower economic activity. A concern about the initial push was a concern of recession. Shortly after that, so we had the 10-year move from about 4.3% the whole way down to 3.8% in a number of days. That's a very big move in yields. Shortly after that, those recession fears sort of converted over and moved yields higher, almost up to 4.6%. So a major swing in the course of about a week that really, I think, precipitated the delay of implementing tariffs. So this is one of those moments when you'll hear the term bond vigilantes, was an old term from the 90s, where the market is really weighing in on policy by saying, look, it's going to cost you more to finance this operation if these are the kind of policies you're going to put in place. And we got essentially a step back from the implementation, and a step back from a few other things following that. So the markets will react and be heard, hopefully, as we work our way through the policy uncertainty that we're dealing with. The next slide is kind of what I want to talk a little bit about is, again, on bond markets. This is essentially the difference between a government bond and a triple B rated corporate bond. So this is trying to give you a sense for how much additional compensation over time are investors demanding for taking credit risk. And you can see that there are spikes periodically. There was a major long duration spike in credit spreads during the financial crisis. That's sort of in the middle of the graph. There was a major spike in credit spreads during COVID. These were periods of, and kind of referring back to market dysfunction, where there were really issues in terms of liquidity in the market. These were periods of time when the Fed came in and started to use their balance sheet to stabilize assets, fixed income assets in the market. And I want to point that out just to say that if you look at that far right, you see there's a little bit of a leg up there, but not much. We have seen a little bit of spread widening just these past couple of months, and really this quarter, a shift higher. So it's not crisis moment here. We see what a crisis moment looks like. We're nowhere near that, but it is indicating a little bit more concern about credit, and really we kind of look at it as an opportunity to pick up some additional yield in bond portfolios. Moving on to just briefly equity performance. We talked about the market as a whole. This is kind of drilling down into sector performance, and there are two shades of blue here. The darker blue is the first quarter performance by sector. The lighter shaded color is just this quarter to date, so since March 31st. So you can see that in the first quarter we did see a pullback, a significant pullback, primarily in sectors that had the very best performance in 2024. That is technology, consumer discretionary, and communication services. So there was early concern about tariffs, conversations about tariffs, and the expectation that it could really kind of slow down capital spending and impact those firms that were really riding the artificial intelligence wave. So we saw that occurring in the first quarter of the year. Since the announcement of tariffs at early this quarter, kind of seen the market as a whole, really all sectors have sold off to some degree or another. There still is, a bit of a benefit to being in what you might consider defensive sectors. Consumer staples, you see, have been up in both quarters, just barely so far this quarter to date. Utilities, just a narrow loss, but really the implementation initially, the announcement of tariffs has hit all sectors really across the board. And then, just to kind of give, again, longer perspective, Bradford's going to get into this a little bit deeper, but we like this chart. It gives, a sense for, what can happen throughout a year, any given year. And you see these red numbers in the bottom. Those are market lows within each year that's depicted on the graph, going back to 1980, right? So, we typically don't end in the low, right? We were as low year to date at the time this chart was run, as low as 10%. We were down about 5 when the chart was run, and this is, I believe, a quarter to date chart. Last year the market closed up 23%. Believe it or not, we were down 8 at one point. So again, just trying to reinforce that we have bouts of volatility, but ultimately we do find our way through, and markets are driven by return expectations. Investors are driven by return expectations. When you get a major sell-off, we have a bit of a crisis of market confidence right now. Ultimately, the confidence returns, and value seekers come into the market, and there are opportunities to buy at very attractive prices. So again, we'll just try to reinforce that. I do want to talk a little bit now just about a couple things around trade and tariffs. So this graph is kind of speaks for itself, but really an economic policy uncertainty index that we pulled from Bloomberg, just to say that we've never seen this kind of trade uncertainty. It's on the chart, but barely. So really exceptional level of policy uncertainty. You know, we can see that we had some significant policy uncertainty during the last Trump administration. We had a bump there, but generally this is kind of a non-event factor. When we kind of look at the markets and tariffs over time, we can see that, and the white line in this graph is the VIX, the volatility index, so market volatility versus the market valuation, which is the blue shaded area. So, you know, going back to 2017-18, we had these tariff announcements, which are indicated on the chart. You see corresponding spikes in volatility, but ultimately markets assimilating this new information into valuations and then moving forward. Right, so significant spike in volatility there in the middle of the graph. That is COVID, right? That is market dysfunction. Markets have, you know, while we've seen a major spike in volatility and volatility come back down, a major drawdown in the market and market recover a bit here in the far right. Markets have been able to clear. We haven't had liquidity issues in the market. You know, you could argue it's been a very ugly returns, but it's been an orderly market, which I think is really important. The last thing that I want to spend a little bit of time on is just kind of the basis for, you know, what do we know about tariffs? Like, what do we learn about tariffs when we were in business school, kind of, and why broadly we're hearing market participants say, hey, like, this is not a good thing. This concept of tariffs is not productive. And so this kind of goes back again to economics 101 sort of, but the graph in the top in the middle is depicting essentially supply and demand curves. So if we're looking at a domestic market, you can think about the price on the vertical and the quantity on the horizontal. So demand as the line moving from lower left to upper right, that's supply at left to right. Thank you, Jesse. He's got the laser pointer out here for me. So as prices go up, supply will go up. Conversely, as prices go down, demand goes up, quantity. So where these two lines intersect is the price and quantity equilibrium. So again, these are in reality not straight lines, they're curved, but for simplicity's sake, if you think about it, as prices go up, you're going to want to sell more products. As prices go up, consumers are going to want to buy less. But there's a point at which we all meet in the middle. When we layer in trade, we're essentially adding this graph in the bottom, which is the price and quantity of the world supply, right? So what does that actually do is it reduces the overall price and ultimately moves the equilibrium levels down, right? So we now have this demand at a higher level and price at a lower level because we're obtaining goods from outside of the domestic market. So when you're looking at the graph in the bottom right, who's benefiting there? You can see this large purple shaded area. That's the consumer surplus. The consumer can buy more goods at a lower price, right? The producer is going to produce less at a lower price, right? So again, if we're able to, going back to the basics, if we're able to source goods for a lower price in a foreign market, yes, there's going to be less domestic production. But ultimately it benefits the buyers, right? So now if we take this concept and go to the next slide, what happens when we're then adding in a tariff, right? So a tariff, as you can see, essentially just moves that price curve, that world price curve up, right? So it increases cost and it reduces quantity, right? So at this new higher green line, you can see that we have the Q3 and Q4 marks. So the total imported amount is lower. Consumers are paying more and buying less. Producers are the beneficiaries. They're producing more at a slightly higher price relative to where they were. So increased costs, another way of saying that is inflation. Reduced quantity, another way of saying that is less growth, right? So why do economists and market participants not necessarily like the idea of tariffs? The concern here is it's going to create lower growth and higher inflation, again, stagflation, to kind of go back to what I talked about earlier. When we look at the shaded areas, that purple shaded area is smaller for consumers. So it hurts consumers. It does benefit domestic producers. And it generates this green box, which is revenue for the government. But then there are these yellow boxes, right, which are what economists call dead weight loss, which essentially is occurring whenever the market's out of equilibrium, right? So it's a loss of economic efficiency, which an economist would say is society would benefit if the economy were operating optimally. So this is just lost activity that really is to no one's benefit. So when we hear about economists and market strategists talking about why we don't like tariffs, well, this is it, right? Because it really is an inefficiency in the market. It creates an inefficiency in the market, and so I think also this is why my view is that eventually we work our way back to trying to come up with relationships that can be as efficient as possible, and that the really drastic tariffs that have been threatened probably don't stick in the long run, because it benefits no one, ultimately, other than potentially the government via tax revenue. But again, that revenue is going to be on a shrinking base because higher prices will drive quantity lower. Quantity lower means slower economic growth. That means slower tax revenue elsewhere. So, I thought it would be interesting to kind of go through sort of the basics of this relationship. And with that, I will turn things over to Debbie, and she's going to give us a sense for kind of where we are in terms of our economy and where we think we might be headed.
Okay, thanks, Ed. Welcome, everyone. This time in this webinar, we're going to talk a little bit differently using terms hard data and soft data. So hard data is backward looking. It's measuring what's already happened. Whereas soft data is going to be looking at how businesses and consumers are feeling and how they are basing decisions basing on how they are feeling. So the first piece of data we're going to look at is going to be GDP. And we know from previous webinars that our growth in the US economy has been trending at about 2.1% since 2001. And you can see in the last 3 quarters of 2024, we were above that trend, especially strong quarters in the second and third quarter. But a lot of that growth and the growth that's coming from our economy is from that blue portion of the line, which is consumption, right? So consumers are really generating the growth of our economy, and the consumer as of the fourth quarter is still spending. We will get our first look at first quarter 2025 GDP next week. The consensus estimate is that that's going to come in below trend at just 1%. So again, signs that the economy is starting to slow. There are other estimates, for example, from the Atlanta Federal Reserve. They have a current metric that they use called GDP Now that updates based every time new data comes out. And that estimate is actually calling for a contraction of 2.5% in the first quarter. So we'll get to take a look at that next week. In March, when the Fed last met, they came out with their summary of economic projections, and they also lowered their estimates for growth for this year from 2.1 to 1.7%. So the general consensus is that growth will be slowing, but we're not going to start to see the effects of tariffs, we don't think, in these first quarter numbers, because they really didn't start to get implemented until the latter half of March, and definitely going forward into the second quarter in April there. Now we're going to move on and look at the labor market. Here on the left-hand side, we're looking at payroll gains. So the blue lines are looking at the monthly job gains that the market is seeing. And we can see that there is quite volatile, but remains robust. That black line is looking at the 3-month moving average since last summer. And an average of 200,000 is above the minimum level of about 100,000 that the economy needs to absorb all of the new workers entering the market each month. On the right, we're looking at initial jobless claims. So here we can see that since about mid last year, we are seeing an uptick in jobless claims. But as of late, that really started to tick down a little bit. But for the most part, since coming out of the pandemic, we've been trading in this range, or having these numbers come in a range between 200 and 250,000 a month. And we're currently right in the middle of that range. We do want to keep an eye on this, because if companies are seeing their prices increase due to these tariffs that are hitting, and they want to keep their margins consistent and not pass on those price increases to their customers, they may look to cut expenses, and they may do that in reducing the size of their labor force. So we do want to keep an eye on this. So the general takeaway here is that the market is still strong. We may be starting to see some cracks, but nothing that is worrisome. The next chart we're looking at is a chart on those job cuts that have been announced. So there's a company called Challenger, Gray and Christmas. It's a career consulting firm that monitors job cuts that are announced every month. So if a tech company comes out and says we're going to reduce 5% of our labor force or things like that, they're looking at that, and then they're calculating that. So these are things that have been announced but are not yet being translated into any of the unemployment claims or things like that, or other labor market data. The most recent report that came out in March showed a 60% increase in March over February of 275,000. Now, of that 216,000 were jobs cut in the federal government as a result of the Department of Government Efficiency and the effects, the actions that they have taken. So we're seeing an uptick in the job announcements, but there's some caveats to this, because of those federal workers that are announced job cuts, some of them were called back, and this is not able to take into account that information. Some have filed lawsuits, so to get their jobs back, that's not taken into consideration. And some of the employment, the federal workers who were laid off have severance packages. So we may not even see the effects of those layoffs come through in the data until those severance packages are over. And we may not see that till sometime in the fall. Looking again further just at unemployment and wages, here we can see the wage growth in the blue line declined from its March 22 highs of 7%. It's down about 3.8%, so in line with its 50-year average. Unemployment has ticked down significantly from its high in April of 20 from 14.8 to about 4.2%. Now, this 4.2% is up slightly from the multi-decade low of about 3.4% that we saw in 2023, but still remains well below its 50-year historical average of 6.1%. Now, what's going to be interesting is that there has been commentary out that the recent immigration policies may end up keeping unemployment low due to not having as much of a workforce here. But we're going to look now at the consumer and what consumers are doing with their money. We have a very full labor market, so people are working and earning money. So what are they doing with it? The blue bar is looking at disposable personal income. So this is income that people have after taxes have been paid or deducted. So they can either spend it or they can save it. And disposable personal income has been rising over the past several months, and for the most part, and we can see that by the orange bar, except for January, consumers are spending it. We saw that in January, retail sales declined, but for the most part, we are still spending. But if we look at the black line, and that is consumer savings. So when consumers pulled back in January and didn't spending, we did see an increase in the savings rate. And if people are unsure about their job situation, you are going to see them saving more and becoming more conservative and spending less. We will get some more data out on this next week. And it is, like I said, important to gauge the financial strength of the consumer and their ability to spend, as it's critical to the growth of our economy. So now let's take a look at what's happening with prices in our country. So we've seen this chart before. This is looking at the drivers of inflation going back all the way to the beginning of 2018. And since peaking in June of 22, inflation pressures have really come down a little bit, but have moved a bit higher since last fall. February CPI came in at 2.8%. That was slightly lower than the January reading of 3%, but still sits higher than the 2.4 that we saw in September of 2024, and it is still above the Fed's target of 2%. So what's really driving that still? We see that auto insurance is the red bar. That has come down in an orderly fashion, but it is still elevated compared to historical norms. Shelter, which is about 30% of the component of this index, has come down, but again, it still remains high and elevated and well above pre-pandemic levels. Core goods, which were a deflationary effect in much of 2024, it's that orange bar at the bottom, has really re-engaged. A lot of that has to do with new and used autos that are being replaced by those affected by the hurricanes and the wildfires. So we saw a lot of demand tick up for those replacements. With current tariffs in place in China, Canada, and Mexico, we do expect to see that prices could rise meaningfully in the months ahead, but we don't necessarily expect to see it show up in the data anytime soon. There's evidence that many companies pre-ordered inventory and front-loaded that so to avoid the tariffs. So there may be some time before we start to see price increases really hit the consumer. So now we're going to start to take a look at how some of the soft data and how consumers and businesses are feeling about the economy. So here we're looking at consumer confidence, and there's two measures of consumer confidence that we can use. There's University of Michigan, which is a more detailed and broad-based survey that's done, but it's done on a smaller sample versus the Conference Board that does a wider sample of its survey. But regardless of the methodology, we can see that this number is declining to levels we have not seen since the pandemic. We got a final reading on University of Michigan sentiment this morning, was to 52.2%. It was down about 8% from March. There is other data that comes out of these surveys. Some of them, just a high point here, 67% of consumers are expecting unemployment to rise, and that's been up for 5 consecutive months. They're also showing that expectations are that prices will rise over the next 12 months, driving inflation higher. Again, declining confidence in the consumer, who makes up 70% of our economy, and their negative expectations is a problem and could lead to slower overall growth. And we need the consumer to continue to spend. So let's take a look at how CEOs and businesses are feeling about things. There's 2 surveys here. The first one I want to look at is the blue line, and that is the NFIB, Small Business Optimism. That is the National Federation of Independent Businesses. So they're surveying all their businesses to determine how they're feeling about things and what their plans are for the future. And you can see here that in the 4th quarter of last year, there was a lot of optimism among small businesses. You had the Fed lowering interest rates, and businesses tend to borrow a lot, so they want to see the borrowing costs go down, and a more favorable, like, pro-business environment. But that has changed, and we have seen that it's begun to decline in March. A large percentage of owners that were expecting better business conditions fell for the 3rd consecutive month, largest monthly decline since December of 2020, and 30% showed that they plan to raise prices over the next year. The black line is a CEO survey, so looking at how they feel about the economy, and it's done on a scale of 1 to 10, with 1 being poor and 10 being excellent. And we saw again an uptick post-election on a friendlier M&A, friendlier FTC to allow for more merger and acquisition, and more favorable tax policies and a regulatory environment. The data here shows as of January, it was 6.3%, but more recent data shows that this index dropped to even further to 4.6%, which was the lowest level since the pandemic began. CEOs noted that tariffs were the overwhelmingly responsible for their declining optimism, and 81% of CEOs expected their costs for goods, services, and their workers to increase. One participant commented that uncertainty is playing havoc with making decisions for us and our customers. So you can see that both consumers and businesses are increasingly concerned about the environment we're in. So let's take a look now at consumer sentiment and the 12-month returns for the S&P 500. So here, the blue dots represent either a peak or trough in the University of Michigan Consumer Sentiment Index going back to 1971. During that time, there have been 10 peaks and 9 troughs. And then the chart is showing us the performance of the S&P 500 after each of these inflection points. So what this shows is that the troughs in sentiment tend to precede strong equity returns, while peaks in sentiments do not see that much upside. It also shows that getting out of the market during these troughs and sentiments can be a poor investment strategy. So with all the hard data still showing a strong and stable economy, and soft data, though, indicating that growth may slow, prices may rise, there's a bit of a disconnect. Not only that, but we also don't know when some of this softer data is going to start to show in the hard data, and make it difficult for consumers and businesses and even the Federal Reserve to determine what next steps should be. So let's take a look at the Federal Reserve. So this is a chart we've seen before, and it's showing the path of the Federal Reserve's target rate since 1993 and where they think the rates are going to go in the future. So, remember that the Fed was on aggressively hiked rates in 2022 and 2023 and then remained on hold. And all of that was to work to bring inflation down. And then starting in September of last year, we saw the Fed reduce its target rate by 1%. And it's been on pause at its January and its March meeting. Remember, they've got a dual mandate of price stability, so maintaining, inflation levels, and they've got a target of 2%, but they also have that target of full employment. So in September, now that they felt that inflation was going to come down in a sustainable way, they felt comfortable lowering rates. And we are currently at a 4.25 to 4.5% range for the Federal Reserve rate. But you can see that that is well above what they consider to be forecast to be their neutral rate of about 3%. So it's still considered restrictive. But if inflation is going to rise, they might not want to lower rates. But if unemployment starts to rise, they may want to lower rates to sort of spur the growth in the economy. So it's quite a conundrum for them. The Fed has indicated that they're continuing to be data dependent and will watch the information as they come in. But keep in mind, this data is always backwards looking, and we may not even start to see any of the effects of the tariffs come through in any of the data sometime soon. So definitely being pulled in different directions. At the last meeting in March, when they did release their summary of economic projections, they still forecast for 2 rate cuts this year. And the market is also pricing in at least 2 rate cuts. Now, the market is expecting that the Fed will cut rates in June. That may be a little too soon. They will meet in May. We definitely don't think they'll be cutting rates or making any movement on rates at that point in time. So we'll have to just wait and see. The last thing I want to talk about, which Ed mentioned, is stagflation. So I know this is a little bit of a busy chart, and this chart is actually on something called the misery index, and it's calculated by adding the unemployment rate to the inflation rate, and it's a measure of economic distress. So the definition of stagflation is high inflation, high unemployment, and slowing growth. So the misery index really can give us a nice gauge of stagflation. The red bars here indicate periods of recession, and you can see huge spikes in the 1970s when we saw high unemployment and high oil prices. We also saw spikes in the financial crisis in 08 and 09, and then again around the pandemic. Recently, we have seen economists lower their growth estimates and raise their inflation expectations due to the different policy shifts, and the Federal Reserve has done this as well. This index did hit 7 in January of the year, and it has declined a bit as of late to 6.6. But even at 6.6, we're below the long run average, going all the way back to 1947. So we're really taking a long period of time in here. So the question is, where does that leave us? The hard data still shows an economy that's on strong footing, yet the soft data shows concerns held by consumers and businesses alike have an uncertainty regarding the economic path forward. So we do expect that we're going to get more clarity on in the coming months on policy that will ease concerns, and it will allow consumers and businesses to plan going forward. And with that, I will turn it over to Bradford.
Debbie, thank you very much for all of the data that you have given us. It is overwhelming, and it all correlates to that steady outlook that Ed has given us, and that feeling of that port in the storm, the steady hand during unstable times. And unstable times create a lot of concern and emotion for people in the markets. And that's really what I'm going to focus in on today. And that's going to be the behavioral side. The reason people work with professionals like Ed and like Debbie is because they're going to take a very unemotional look at the markets, where the average investor, who I'm going to be talking about today, and who we are, the clients that we work with, they look at things sometimes in a very emotional way, and behavior plays a role in that. And behavioral finance is that intersection of the psychology of what's going to go on in finance, and it explains why people do some irrational things sometimes. It's not just finance, but it's all things in life. I can tell you, I'm a father of 3. I had a daughter who's 16. She started driving. She got in an accident. I never wanted her to drive ever again. I panicked, and she was a great driver. I would trust her every time she got in the car, except for that one time. And it was an accident. Something bad happened, and I got concerned, and I pulled back. And there was no need to do that. And that's really what we're going to be looking at. And understanding why we react to certain things at certain times and thinking about why we do it helps us with making these decisions. And if we know that, it can help us prevent doing things that would create unnecessary losses. Now, over decades, the things that have happened in the economy have been happening more and more and more. And the more it has happened, the more we have been reacting to it. And things have been happening in the economy for a very long time. If we just look back into the 80s, we can see that it is not a straight line up and to the right. We've got some peaks, we've got some valleys, we've got some plateaus. There have been some fantastic things that have happened. And that's when everybody wants to invest. And there have been some horrible things that have happened. And that's when everybody wants to get out of the market. On average, we dip into these difficult times about every 6 years. And this is just an ongoing thing that happens over and over again. And there's this investor that some people might know called Warren Buffett. And I don't want to mess up the quote here, but he says, what we learn from history is that people don't learn from history. When investors either get too fearful or too greedy, they sometimes hide behind the notion that this time is different. Usually they regret it, he said. Now, this isn't some nobody. I mean, he is a very well-to-do investor, and he is known for taking advantage of these difficult times in the market. When everybody's running out, he's running in. And this chart shows us all of the times that we could get in that we potentially got out. And just to keep something in mind here, and I don't want to take up too much time, but if we look at this chart and we assume that we invested $5,000 a year from 1980 until the end of this chart in 2023, if we would have been fearful and just put that in cash, we'd have $350,000. You know, that's a pretty good number. If we took that $5,000 and invested it monthly, so broke it up over the year, about $417, and put it in every single month at the beginning of the month, over this entire period of time, we'd have $4.8 million. There's a big difference between 350 because we're fearful and just being steady and methodical and investing over a long period of time. Now, you might be thinking, well, what happens if I chose the worst times to invest? The market was at its peak. I got in because I was all excited. And then I didn't get in again until it was at its peak again every single year. Well, you still would have been better off than being in cash, because that dollar value comes to about $4.2 million. So what we're looking at here is, what can we do to stay calm in the storm? You know, to have that steady hand and to believe in what Ed and Debbie have been telling us and going over, because they're the ones who are looking at all of this. Now, when we look at this, we can see that over the past time frame, things have not been stable. When we look at the last 22 years on the next slide, we can actually see that over this time period, over the past 22 years, it has gotten more erratic, more volatile than it has been over the prior 50 years. So we have had more 2% declines from 2002 to 2023 than we had from 1952 to 2001. And part of this is how people react and how much information is coming to us. Now, we look at this and we know that as this happens, it becomes more difficult to invest. The average investor feels a loss 2 times more than they feel a gain. That is a very emotional thing, that fear of losing. And people only want to take the risk when they think they can do double what that growth can be. So it's very convoluted and confusing. People only want to invest when they think they can double their money, but the ability to double their money comes with risk, and they feel that loss of risk twice as much. So we're at a standstill where people don't do anything. That theory of just keeping their money in cash. And that makes people very concerned with what to do when these things happen. You know, we look for Debbie, we look for Ed to make sure we do the things that we don't do on our own. And one of the things that we don't do on our own is stay the course all the time. With all the information that comes at us, with all the news cycles, 24 hours a day, everything that's going on, it impacts our behavior. And the more we see it, the more we feel it, the less we want to be part of it. And that short-term focus, just focusing on the tree and not the forest, has a tendency to make people want to be more conservative. You know, right now, on average, somebody's looking at their phone every 10 minutes, and they're spending about 5.5 hours on their phone every single day looking at things. And it happens quickly. You know, you have that app on your phone that tells you how often you're looking at things. But when we look to see what does the average investor do, people who are constantly checking or constantly nervous and constantly on edge constantly want to take less risk. And somebody who's reviewing their portfolio all of the time always wants to take less risk. Somebody who takes a longer term approach has the ability to handle those volatile times and can stay more aggressive to weather the storm. And by being more stable and not allowing short-term influences to impact our long-term goals has a true gain in overall return over time. When we get to know this and get to feel comfortable with this, just like I'm comfortable with my daughter driving now, I'd let her drive anywhere. I think it's the greatest thing in the world. She goes and picks up my kids. It's absolutely fantastic. But for that point in time where I was nervous and I didn't want anything to happen to my daughter, I pulled back. And what we see here, when people pull back when it comes to investments, it impacts them greatly. And believe it or not, fixed income gets impacted even more. It's a more complex market. It's more confusing. People don't understand it. It's much less aggressive, much more stable than equities, but people are more comfortable with equities. And what we see is the average investor ends up not making as much because they're taking money in and out of the market over a period of time. So this chart from 94 to 2023 is showing you they're losing out by about 2% in total return over that period of time, by over 4%. And a diversified investor, if they were to stay in the market, would make about 7.25%, compared to only making about 4% by getting concerned and taking their money out and then putting their money back in and making those trades and those transactions and those risk changes based on what is happening in the short term. But keep in mind, April showers and all this volatility will bring May flowers. And that's really what we want to look at right now. How can we take advantage of all this rain, all of these downturns in the market, all of this distress? It's not all bad. There are some good things that we can get out of this. Now, what are those good things? Well, there's a couple of things, but there's two that I'm going to look at today. The first one comes to something called a Roth conversion. Now, you've probably heard this term. You've probably worked with, one of the wealth advisors, financial advisors here who have brought this up, and we have tools to help figure out, well, should I do it? Is it, what's the best time to do it? Now, when the markets are down, is the best time to do it. It will allow you to move more money and pay less taxes, not only now, but also in the future. Kind of some downturns. Well, if you put money in, you can't take it out for 5 years. Well, it's kind of a misnomer in the fact that you could take the principal out, you just can't take the gains out for 5 years. And it is a little confusing, so I don't want to go, into this in depth, but this can help you because you're going to pay taxes up front, but you're never going to pay taxes again. It never in the future has a required minimum distribution on it while you're alive. And if you want to pass money on to the next generation, a Roth IRA and a conversion is substantially better than passing money along, especially with what happened in Secure Act 2.0, than a standard or typical IRA. So it's something that I would advise you, if it's on your mind, if you want to take advantage of it. I talk to my clients about it. I took advantage of this with them. Talk to your advisor. The other thing that we do more proactively for you is something called tax loss harvesting. Now, this concept is not always the easiest thing. I'm going to try and make it very basic. The market, as that slide shows that Ed did in the beginning, in 1 year can dramatically change. It can, we can go to the lows and we can finish on a high. And we want to take advantage of that. And basically, tax loss harvesting allows you to do that. Now, what you see on this chart are two investments that we have in accounts. One is called Salesforce. You've probably heard of it. That's, I believe, the white line. And the blue is something called ServiceNow. ServiceNow?
ServiceNow.
ServiceNow. Look at that. Debbie, the portfolio manager, helping me out here. Now, what this does is these two, as you can see on the chart, the reason we have the chart is they trade very similarly. So we can go in and out of them and have the same type of return. Now, what tax loss harvesting does is it says, basically, the market's down. Let's sell out of one of these. Doesn't matter, whatever we own. Harvest that loss and put that in our back pocket to use it later this year or a couple years down the line if we need to. And get into a similar investment out of ServiceNow into Salesforce, out of Salesforce into ServiceNow. We'll get the same return. We'll take advantage of the down of the market. So when the market goes up and we want to sell something, whether it's one of these two or something else, we can use the loss that we harvested here against a gain and create zero tax implication. Now, there are more nuanced points to this. You can use $3,000 of this loss against income, but you have an unlimited loss potential if you want to against other gains. Again, if you want to learn more than happy to go over it and review it. Just ask any of your financial advisors to give you that helping hand. Now, there are some other more unique things that we can help individuals with, other opportunities during a down market. One that's very obvious is gifting. You can gift shares of stock a lot more at a lower price to an individual, to a grandchild, to a child, to whomever at this point in time. Get them more shares and have the growth happen in their account where they might be paying less in taxes if they were to cash it out. There are these other things that we can do, granted retained annuity trusts. All of these help take advantage of a lower market because you can get a whole lot more into these types of vehicles right now with the market being lower. And then the growth is no longer in your estate. It's now in these vehicles to grow moving forward. Again, they're more complex topics, but I want to let you know there's not just two things. There are many things that we can take advantage of in this market. Now, with all that being said, there's been a lot of data, a lot of information given out over this. If you want, I am more than happy to read this last slide. It's our legal slide. As quickly and as fast as I can. I can sound like one of those telemarketers, going through this. You probably don't want to hear me do that, though. What I want to do is have Becky help us out and close us out. But thank you very much for your time, everyone.
Thank you, Brad, for Debbie and Ed for this very informative webinar. Thank you all for joining us today. The topics are deep and they continue to have a life of their own. And while we talked in generalities today, we certainly are here to work with you on your specific situation. So feel free to contact your wealth advisor, the portfolio managers, or any of us on the team. We are all here for you and appreciate your trust and ongoing partnership. With that, have a wonderful weekend, and we look forward to seeing you soon.